founder of Three Pillars Capital. We're a private real estate firm down here in Houston, Texas. I got my career start as an engineer, actually. And then I started working in institutional finance as a quantitative analyst. So that's kind of how I was able to build up my prowess for underwriting and analyzing deals. And but all along the side, I was always in real estate. I had several single-family rentals, and at the time I was in Florida, and built up a portfolio from there, and decided that I wanted to do something bigger and grander, and start a company that was able to really scale and take it on full speed. And so I bridged the gap into multifamily, and we've been in Houston now for about 3.5 years. And our company, Three Pillars Capital, we focus on what we call value add Class B and C properties. So it's workforce housing, and kind of what we look for is properties that are either mismanaged or the rents are super below market, bloated expenses. And then we'll go in and we'll upgrade the units with luxury finishes. Because we do everything in-house, our construction team is in-house, our management is in-house, we're able to do all of that for a very low cost. And so the rents that we need to achieve our business plan and give investors a good return isn't all that high. So we have a really good luxury looking product for that demographic, the workforce, blue collar type tenant profile. And we're able to hit it out of the park pretty much on every deal that we're doing. So that's a little bit about us. I'll let maybe Mark say a bit about himself.
Yeah, hi, my name is Mark Shuler. I am the president and founder of Shuler Group Real Equity. I'm based out of both Seattle, Washington, and Houston now. Been doing real estate for about 8 to 10 years, parallel to a 35-year career as a practicing architect. Done hundreds and hundreds of projects, have always been in the housing space. So I've done single family, ground up construction, rehabs, remodels, done a lot of multifamily, have designed some huge apartment buildings. And about 8 years ago, decided to make some money myself by getting into the development game. Had worked with a lot of developers over the years, learned the business pretty thoroughly, just looking over their shoulder. Got my underwriting prowess through the University of Washington. I obtained an advanced degree in commercial real estate development from the UW Foster School of Business. And just been out here for a lot of years doing deals. Have 5 family members who are commercial brokers, so it's sort of the business is in my DNA. About 3 years or so ago, Josh, I hooked up with you and started doing deals together down in Houston. I found that Seattle's market was getting hyper inflated, overheated, and that the pricing of assets up here was too much. So I decided to go down there, started looking around. Josh and I met and just immediately hit it off. We have a very similar philosophy about the business. Value add, B and C class, market force housing is all I've ever been interested in. I don't want to do ground up A class product. It's too risky. And just like the style of his underwriting, the style of his business model. And, we just started doing deals together. And here we are, we're on our 5th or 6th deal. So, yep.
So yeah, syndication model is great. I mean, we raise capital on all of our deals. And the reason for that is just scalability, right? I mean, we're trying to grow a very large organization, and we're trying to gain economies of scale. But you can't do that if you're trying to buy these properties with your own bankroll or 1 or 2 other people. Like, you really need kind of a massive push behind you, and that's why we do syndication. Because once you get up into these bigger deals that we're doing now, this deal we'll talk about in a second, it's 520 units. It's a $62 million deal. There is massive economies of scale that you get, and everybody that is involved from a equity standpoint as an investor can reap the benefits of being involved in that big place or that large scale project. And so that's the big reason why we do it. It helps us grow our organization faster, and just really helps drive up returns.
Yeah, I think a couple of points I'd like to add to that is, Josh touched on it, is economies of scale. You can really drive, your unit costs down when you have a larger deal that you're doing, and also grow the returns that you can pay to your investors. A big part of our secret sauce is that we do everything in-house. So we have, I don't even know how many guys are on the payroll now, but a lot of people who are working for us that turn the units. And then there's an asset management side to the business as well. So, it's a vertically integrated company that economizes on our costs. So we have great cost efficiency. All of that gets driven to the bottom line and makes us hyper competitive relative to our other syndicators that are out in the marketplace right now. I tend to think that we're delivering 4, maybe 5 points more than other syndicators on a similar deal, just because of our cost structure.
So the deal that we are currently, closing on very shortly here, it's a 520 unit multifamily value add deal here in a very dense, very well desirable part of Houston in the Texas Medical Center. It's a 2-property portfolio. And the history behind it is we've actually know this seller very well. We've worked with him on 2 other deals before this. So this will be the 3rd and 4th property we've bought from this particular seller. And it's been in the ownership of the seller the entire time since it was built. It's a family. They built it in the late 70s, early 80s. And they're of the mindset where, they've owned it for so long, they don't have any debt on the property. Literally every piece of cash flow that goes through right now is just money in their pocket. So this has kind of created an environment of not really fixing things 100%, putting Band-Aid solutions on CapEx items, not updating units to keep up with the market and competitors, because they don't have to, right? If you're just receiving cash flow free and clear, and it's just been in your family for that long, the motivation isn't there for you to really try to, tighten up the bolts and squeeze out more juice from the lemon. And just as an example, Ridge Point Apartments was the 2nd property I explained that we bought from the seller. This property, it's 168 units, is located right next door to these 2 properties, these 520 units. And after 6 months of ownership, we've already hit more than our rent targets of 15 to 20% across all the floor plans. We've slashed expenses by over 30%. And we have already given out 4% worth of distributions in just 6 months, which is way ahead of the pace that we were planning on in the first place. And so if that is any indication of what is to come for Main and West Ridge, we've done a couple of things. One, we've de-risked the deal because we already know what we're getting into, because we know the seller and how he operates. And 2, we have a very good handle on the renovations and what is attracting the tenants in this market. And the fact that our leasing has been just, the units have been flying off the shelves, even in the middle of COVID and when everybody's panicking, we've been doing quite well and been able to maintain very healthy collections and occupancy through this whole time. So just to kind of recap, Main and West, it'll be the 3rd and 4th deal we bought from the seller. We know exactly what we're in for from a renovation and rent bump standpoint. And so all in all, it's going to be a great deal, one that we're very excited about. And one last thing I'll mention too is it's in the Texas Medical Center, which is a very stable part of Houston. There's a lot of redevelopment going on around us. There's several Class A apartment buildings being built right now. And not only that, but there is a expansion project of the research center, the Texas Medical Research Center. It's a $1.5 billion project that's going to be taking place over the next 5 to 7 years. That's going to bring another 30,000 jobs roughly to the area. So you have a very dense market with a lot of people that run the healthcare, the health services industry in that particular area. Healthcare is not going anywhere. We can all agree to that. And it's not that everybody who lives in these areas are all high-paying doctors and 6-figure professionals, right? There's a lot of people like security guards, admin, workforce, blue-collar type that run these health facilities. And these are the people that we're catering to, and we're right next door to all of that. So we're very excited about it.
Yeah, one couple other points that I'll add to this, a little more high level than the details Josh was going over, is Ridge Point, the 2nd deal that we purchased from the seller, is a perfect illustration of our fundamental business model, which is, C-class assets like this are recession-proof. The theory is that in recessions, A-class flees to B-class and B-class flees to C-class. We are having no problem leasing up the units. not the least of which is because everybody is fleeing our way. So, even in the worst economic recession in the last 100 years, we are hitting it out of the park on our business model. I'm not sure there's much else I can add to this. I mean, I think Josh covered pretty well. It's, a very opportunistic value add play that's workforce oriented. And we have a lot of new job creation going on less than a mile away. In the multifamily space. As job growth goes, so does rent growth. As rent growth goes, so does asset valuation and returns to the investors. So we feel like we have a really good, solid business plan in place. And not only that, we have proof of concept from the first deal we did on this block. So
that's a good point. Houston's a phenomenal market. Obviously, we've been here for 3.5 years, and it's a very landlord-friendly state for those of you who might be in the East or the West Coast. I know Mark has to deal with this a lot, but you have a lot of government red tape in your way. Things like rent control, just a lot of things that just are against you as far as, trying to run a free business enterprise, right? So in Houston, what we like about it is that there's a ton of multifamily product down here, number one. Number two, a lot of these assets were built in the 70s and the 80s before the savings and loan crisis. There was a huge building frenzy of multifamily here. And so a lot of these apartments are ripe for the taking as far as upgrading, renovating, making them up to current market standards and increasing value. And number three, Houston is now a very diverse economic city. It's not just the oil and gas city from 40 years ago. I mean, there's so much development from healthcare to technology, just all different sorts of industries coming in here now. So if Houston's very diversified, the risk of having oil take a dip and then all of a sudden it's gonna ruin your occupancy, that no longer exists. It's much more diverse and just a huge mogul of a city.
Yeah, a couple of points I'll add to that is I have done several deals in my neck of the woods in the Puget Sound, and it's just gotten to be too expensive here. I mean, Amazon, Microsoft, Boeing, a lot of Fortune 100 companies are based here. And the price of real estate has just become too expensive. I just can't find a deal. I can't make the numbers work. So when I got in the business years ago now, I decided to hunt in my backyard and one other market. I chose Houston because I like what's called the Texas Triangle, where I believe a lot of job growth is going to occur in the next 20 years. And just to mirror what Josh was saying is I can always find a C-class deal down there to renovate and do a value add play on. I personally like very large MSAs that have a very diverse economy, large population base. I just like being able to count on being able to rent up my units. So Houston fits that bill. It's the third largest city in the country now, second largest apartment market. There's just, a lot of things that Houston checks a lot of my boxes.
So the total deal size, it's a $62 million deal. The equity that we're raising of the $62 million is about $20 million. And the projected IRR is a 20% over a 5-year hold. And it is a preferred return deal of 8%. So we're projecting that we'll be able to return 8% roughly on your money every year. And then the goal also with just kind of the renovation, we try to renovate about 5% of the property every month. And if you do the math and you're able to stick to that target, in 20 months, you'll have completed 100% of your renovations, both inside and out. And that will allow us to refinance the property and return a large chunk of equity to our investors. On previous deals that we've done, in fact, on the first deal we ever bought from this particular seller, after 18 months of ownership, we refinanced the property and we were able to return over 60% of equity to investors just from that one refinance. So we were able to create significant value, and in a year and a half, return 60% of investors' money. So that's it. That's what we intend to do here. And so the equity multiple on this deal is a 2-point equity multiple. So basically, we're looking to double your money over 5 years. It's a 20% IRR, 8% preferred return, and a refinance event in the middle after about 20 months that will be good for a 50 to 60% return of capital, potentially even more. The investment minimums on this deal is $25,000, but most of the checks that do come in from from investors have been anywhere from 50 to a million, 50,000 to a million. So we do get quite substantial investors in the deal. And the exit time frame is 5 years, like I mentioned. By renovating 5% of the property every month, we'll be able to get done with renovations after around month 20, do a refinance, get into cheaper debt at that point in time, return investor capital, and then operate the deal until the 5-year hold.